We like to imagine that somewhere in Omaha, there sits a man who never makes a mistake, a financial deity who turns everything he touches into gold. But the truth is far more complex, far more human, and infinitely more instructive. Welcome to the show. Today, we are going to do something that feels almost sacrilegious in the world of finance. We are going to take a long, hard, critical look at the Oracle of Omaha, Warren Buffett. We aren't doing this to tear him down, his track record speaks for itself, but rather to learn from a perspective that is rarely discussed. We are basing this deep dive on the insights of Vahan Janjigian and his provocative book, Even Buffett Isn't Perfect. The premise here is simple but profound. If you blindly follow the legend of Buffett, you might lose your shirt. But if you understand the reality of Buffett, his contradictions, his evolution, and yes, his mistakes, you might just become a better investor. So, let's strip away the mythology and look at the man and the method. Let's start with one of the most confusing contradictions in the Buffett universe, the concept of diversification. If you have ever taken a Finance 101 class or spoken to a financial advisor, you have heard the mantra, diversify, diversify, diversify. Do not put all your eggs in one basket. It is the golden rule of modern portfolio theory. It's the safety net that protects us from ruin. And yet, if you look at how Warren Buffett built his fortune, he did the exact opposite. He is famous for saying that diversification is a protection against ignorance. It makes sense if you think about it from his perspective. If you know how to analyze businesses better than anyone else on earth, why would you dilute your best ideas with your 10th best idea? Buffett made his billions by concentrating his capital into a few high-conviction bets. He loaded the truck when he saw a sure thing. However, and this is a massive however that Janjigian points out, Buffett tells you to do the opposite. He explicitly advises the average investor to buy index funds and diversify broadly. Why the double standard? Is it arrogance? No, it's pragmatism. Buffett knows that 99% of investors do not have the time, the access, or the temperament to analyze a balance sheet like he does. But here is the twist that many people miss. Berkshire Hathaway, the company itself, has changed. In the early days, it was a concentrated bet. Today, it is a sprawling conglomerate. It owns insurance companies, furniture stores, energy companies, carpet manufacturers, and billions in stocks of various public companies. Whether Buffett admits it or not, Berkshire has become a mutual fund in drag. It has become diversified by necessity because it has simply become too big to rely on just 2 or 3 stocks. So, the lesson here isn't don't diversify. It's that you have to understand your own limitations. Unless you can dedicate your life to analyzing annual reports, you are not Warren Buffett, and you probably shouldn't invest like the young, concentrated Warren Buffett. Now, let's move to another area where the public perception of Buffett clashes with reality, the battle between value and growth. You will often hear Buffett described as the ultimate value investor. In the traditional sense, this means buying stocks that are cheap, companies with low price-to-earnings ratios, low price-to-book ratios. The unloved, boring companies. And sure, Buffett has bought plenty of those. But if you look closer, as Janjigian urges us to do, you see that Buffett isn't just hunting for bargains in the discount bin. He is hunting for value, which is a very different thing from cheap. Consider his avoidance of the tech boom in the late 90s. He was mocked for it. People said he lost his touch. He refused to buy high-flying tech stocks because he couldn't understand their future cash flows. He stuck to what he knew, razor blades, soda, and insurance. But fast forward a bit. Buffett has bought companies that exhibit significant growth characteristics. He looks for what is called intrinsic value. This is where we have to get a little technical, but stay with me because this is the secret sauce. Buffett uses a method called discounted cash flow, or DCF. He tries to project how much cash a company will generate from now until Judgment Day. And then he discounts that amount back to what it is worth in today's dollars. If the current stock price is lower than that number, he buys. This means he might buy a company that looks expensive to a traditional value investor because it has a high PE ratio. But if he believes its growth will generate massive cash flow in the future, to him, it is undervalued. He isn't looking for cheap stocks, he is looking for mispriced stocks. A company growing at 20% a year is worth paying a premium for, compared to a company growing at 5%. The mistake many copycat investors make is thinking they just need to buy stocks with low PE ratios to be like Buffett. That is not what he does. He buys future cash flow at a discount. He is essentially an arbitrager of time. This brings us to the romantic notion of the forever holding period. You have heard the quote, "Our favorite holding period is forever." It sounds lovely, doesn't it? It sounds like a marriage. You find a great stock, you marry it, and you stay together through sickness and health. It promotes patience, which is a virtue in investing. But Janjigian points out that taking this advice literally can be hazardous to your wealth. Buffett himself doesn't always hold forever. He dates. And sometimes he breaks up. Take the case of Pier 1 Imports. Buffett bought a significant stake in the home furnishing retailer around 2004. It looked like a classic Buffett value play. The stock was down, the valuation was reasonable. But then, the business deteriorated. The management struggled. The competitive landscape shifted. Did Buffett hold on forever because of some philosophical dogma? No. He realized he made a mistake, he cut his losses, and he sold. He didn't marry the stock, he realized the relationship was toxic. The lesson for us is critical. Buy and hold is a great strategy, but it is not a suicide pact. You have to constantly reevaluate your thesis. If the reasons you bought the stock are no longer true, if the moat has dried up, if the management has lost its way, you have to be willing to sell. Blind loyalty to a ticker symbol isn't investing, it's fanaticism. Now let's wade into deeper, murkier waters, politics and taxes. This is where Vahan Janjigian, the author of our source material, really challenges the oracle. Buffett has famously advocated for higher taxes on the wealthy. He has supported the estate tax, often called the death tax by opponents, arguing that society contributes to a wealthy person's success. So they should give back. He has pointed out the absurdity that his secretary pays a higher tax rate than he does. On the surface, this sounds incredibly noble. But Janjigian argues there is a disconnect between Buffett's public policy stances and his private actions. Buffett is a master of tax avoidance. And I don't mean tax evasion, which is illegal. I mean avoidance, which is smart business. Berkshire Hathaway pays no dividends. Why? Because dividends are taxable to the recipient. By retaining all the earnings within the company, Buffett allows his shareholders to compound their wealth tax-free for decades. He only incurs a tax event when he sells. Furthermore, regarding the estate tax he champions, Buffett has arranged his affairs so that the vast majority of his fortune will go to philanthropy, specifically the Bill and Melinda Gates Foundation, thereby bypassing the very estate tax he supports. Janjigian's critique is sharp here. He argues that estate taxes actually hurt capital formation and punish thrift, and that Buffett's support for them is easy to proclaim when you have structured your entire empire to avoid them. Whether you agree with Buffett's politics or Janjigian's critique, the takeaway for the investor is clear: watch what they do, not just what they say. Understand the tax implications of your investments. Buffett certainly does. We cannot talk about Buffett without talking about mistakes. Real, painful, billion-dollar mistakes. The book highlights the acquisition of General Re as a prime example. In 1998, Berkshire bought General Re, a massive reinsurance company, for $22 billion. It was the biggest deal Buffett had ever done. It looked like a perfect fit. Buffett loves insurance float. But it turned into a nightmare. General Re had a culture of underwriting laxity. They were taking on risks they didn't fully price in. Then came the attacks of September 11, 2001, which hit the insurance industry hard. But beyond the tragedy, General Re had deep structural problems. It was involved in derivative trading that Buffett famously called financial weapons of mass destruction, yet he bought a company filled with them. Buffett admitted in his shareholder letters that he made a deadly mistake with General Re. He failed to do enough due diligence on the culture and the risk exposure. It took years, and a change in management, to turn that ship around. Then there was NetJets. Another acquisition that seemed great, fractional jet ownership for the rich. It sounds like a business with a moat, right? But it turned out to be incredibly capital intensive with razor-thin margins. For years, NetJets bled money. These weren't small hiccups. These were significant drags on Berkshire's performance. The lesson here is incredibly reassuring for the rest of us. Investing is hard. Assessing risk is hard. Even the man with the greatest track record in history can misjudge a culture or a business model. If Warren Buffett can buy a lemon, so can you. The key is not perfection, the key is survival and recovery. Buffett survived General Re because he had a fortress balance sheet. He didn't use leverage that would wipe him out. That is the lesson: mistake tolerance. Let's shift gears to corporate governance. This is a buzzword that usually puts people to sleep, but with Berkshire, it is the elephant in the room. For decades, Berkshire's board of directors was essentially Buffett, his family, and his friends. It was the opposite of independent. Governance experts howled that this was bad practice. Buffett countered that he wanted directors with skin in the game, people who owned massive amounts of Berkshire stock. Not professional directors who just wanted a paycheck. And for a long time, Buffett was right. The board protected shareholders because they were the biggest shareholders. But as Berkshire grew, and as the regulatory environment changed after scandals like Enron, Buffett had to adapt. He brought in Bill Gates. He expanded the board. Yet, the central risk remains the key man risk. Berkshire Hathaway is uniquely tied to the persona and brain of Warren Buffett. He allocates the capital. He sets the culture. He writes the letters. Janjigian raises the uncomfortable question: what happens when he is gone? Buffett has a succession plan, of course. He talks about splitting his role into a CEO part and an investment manager part. He has groomed lieutenants. But can anyone really replace him? The book suggests that while Berkshire will likely survive, it will fundamentally change. It might become more like a normal conglomerate. It might start paying dividends. It might break up. As an investor, you have to price in this mortality risk. You are not just buying the assets, you are buying the steward of those assets. When the steward changes, the thesis changes. Another fascinating area the book explores is the issue of earnings guidance. In the corporate world, Wall Street analysts demand to know what a company will earn next quarter. Most CEOs play the game. They give guidance, saying we expect to earn 50 cents a share. Then they manipulate their accounting or cut necessary R&D spending just to hit that number so the stock doesn't crash. Buffett hates this. He despises it. He refuses to give guidance at Berkshire and encourages his portfolio companies, like Coca-Cola and Washington Post, to stop giving it too. Janjigian plays devil's advocate here. He cites studies showing that when companies stop giving guidance, their stock volatility increases and analyst coverage drops. The market hates uncertainty. By refusing to play the game, Buffett is taking a moral stand. But he might be causing short-term pain for shareholders who have to deal with wilder stock swings. It is a classic conflict between short-term market psychology and long-term business logic. Buffett wins on logic, but the market often runs on psychology. As an investor, you have to decide which game you are playing. If you own a stock that stops giving guidance, are you prepared for the volatility? Buffett asks you to have the stomach for it. So, where does this leave us? After dissecting the myths, the mistakes, and the methods, what is the verdict on Warren Buffett? Vahan Janjigian's book ultimately leads us to a nuanced conclusion. Buffett is a genius, yes. But he is a specific kind of genius operating in a specific context. He is a capital allocator who operates with a permanent capital base, thanks to the insurance float, which allows him to weather storms that would sink a normal hedge fund. He is a man who can move markets just by speaking, a luxury you and I do not have. The danger comes in hero worship. If you tried to copy Buffett's portfolio today, you might be buying stocks he bought 20 years ago at much lower valuations. If you try to adopt his no diversification strategy without his analytical brilliance, you are gambling, not investing. If you hold a losing stock forever because you think that's what Warren would do, you might ride a company all the way to bankruptcy. The true value of studying Buffett, as presented in this analysis, is to learn the principles, not just mimic the actions. Learn to look for intrinsic value. Learn to view a stock as a piece of a business, not a lottery ticket. Learn to be fearful when others are greedy. But also, learn to recognize when the game has changed. Learn that taxes matter. Learn that management integrity matters. And perhaps most importantly, learn to forgive yourself for your investment mistakes. After all, the man who bought General Re and Pier 1 imports makes them too. To wrap this up, Even Buffett Isn't Perfect is a liberating title. It frees us from the pressure of trying to be infallible. Investing is not about being perfect, it is about being generally right over a long period of time, and not getting wiped out in the interim. It is about survival, patience, and continuous learning. Warren Buffett has survived and thrived not because he never fails, but because his winners are massive. And his losers, while painful, don't sink the ship. That is a strategy we can all aspire to, whether we have billions in the bank or are just starting out with our first brokerage account. Thank you for listening to this exploration of the reality behind the Oracle. Keep analyzing, keep skeptical, and remember, even the gods of finance put their pants on one leg at a time.